We didn't expect coming out of the April 2nd announcement was just how severe the reciprocal tariffs would be. Reciprocal implying that we'd probably charge what they charge us, which in many cases is roughly single digits. So to see an average effective tariff rate going forward of nearly 25%, the highest in over 100 years, does have us rethinking how are we looking at the economy going forward. And right now, our economic models are pointing to roughly no growth over the course of 2025. But we have to think about where policy goes from here. Do these policies stick? Do things actually get worse when we think about sectoral tariffs on areas like copper, lumber, pharma products? Could we see retaliation from other countries, as we indeed already are from China, and therefore that further ups tariff rates? So there are still upside and downside risks. We clearly haven't seen the end of this tariff story. So we're still grappling with how do we think about growth and potentially higher inflation going forward?
Well, the markets are certainly repricing for an uncertain environment. Have they repriced enough? Is it a time to go out there and get a shopping list together, or still too early to call?
It's a bit early to call. Even a couple of weeks ago when we saw the 10% correction in the markets, I had four things I was looking at to see more market stabilization. One was a re-rating in valuations. We've seen some of that, but probably not all of that, especially when we think about the re-rating we need to see in earnings. Some downward revisions we would certainly expect to hear about over the next couple of weeks as earnings season kicks off. And so we probably will see more choppiness around some of those announcements as businesses today are thinking about how to cut back on CapEx and hiring to prepare for a potentially higher tariff environment if things do go through as planned. I would also say we're looking at the economic data. Now, the challenge is similar to the jobs report this morning. Any strong economic data we get over the next month, which reflects a pre-tariff environment, is probably going to be dismissed by the market. So it will be a period of time before we actually start to see things in the data. And the fourth thing was really around a consolidation of tariff announcements. We certainly had a big bang consolidation the other night, but again, we have yet to see the full extent of retaliation and if, in fact, that results in higher tariffs out of the U.S. And again, on sector, different markets and materials. And in the absence of that, we're still in a wait-and-see mode.
Yeah, and we just got that retaliation from China overnight, for example. I mean, the S&P is down 8.4% in 2 days. What provides the floor at this point?
We are going to hear from Chair Powell shortly. Hopefully we could get some more dovish commentary. But the challenge with relying on a Fed put is the fact that the Fed has to weigh slower growth, which would cause for them to cut rates, against potentially higher inflation from tariffs, potentially inflation expectations moving higher prior to any movement in the actual inflation numbers. So while we do expect cuts this year from the Fed, there is a limit to really how much they can do in the face of inflation that was already stubborn and could get somewhat more stubborn going forward.
How do you think about allocation stocks, bonds these days? What's changed, if anything, for you over the last couple of days?
Yeah, like what's safe at this point?
Exactly.
The solace we feel in markets here is actually, as of yesterday's market close, you did still have 5 out of the 11 sectors in the S&P 500 positive year to date. So defensives have been an area where people have sought shelter. Areas like healthcare, staples, utilities. Certainly areas like utilities are probably going to be fairly insulated from tariffs, but staples not so fast because of global supply chains, because of thinner margins. And what we actually have seen in slower economies is people do pull back on some of the goods that you would think they wouldn't. People actually do pull back on food and essential household items. So we do have to be a little bit more careful around staples. But value versus growth, we've seen value outperform growth year to date by double-digit percentage points. International versus U.S., we have not only seen international outperform the U.S. by about 13%, but moreover, in dollar terms, that has really helped as you've seen the dollar weaken. So some of these very unloved areas of the market have actually really protected this year. Duration has worked, although I will caution that per my comments about the Fed and inflation, there are still some two-side risks here to yields, but thus far, certainly having core bonds has protected.